Axis Bank slips more than 5% after reporting an operationally weak quarter. Asset quality deteriorates while CASA ratio comes in at a 16-quarter low.
JSPL slides on the back of its Q1 results despite a beat on margins as delayed execution and a weaker than expected operational performance weigh on the numbers.
JK Paper falls over 8% as the weak quarter where profits declined 55% year-on-year. The management says results were impacted by significant drop in market prices and a surge in wood costs.
DCB Bank slips nearly 5% on the back of its first quarter results. The asset quality deteriorates while net interest margin also declines sharply. The management tells CNBC-TV18 that there was a one-off hit on its interest in the first quarter.
RBL Bank also under pressure after nearly 8% equity worth 1,100 crore rupees changes hands on the bourses. Sources say bearing PE is likely seller in a clean-out trade.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangala Malu. Well, the markets are down, but the good news is that the Nifty has at least defended the 24,200 odd mark. The Nifty Bank, though, at a very, very crucial level. The problem for the Nifty Bank is the last few sessions it's been making lower lows. And if you look at the chart, you'll see that now it's at that 50 DMA and a 5% correction from the peak that we saw. So holding on to this 50,500 odd mark is very, very crucial from the bull's perspective. Mangala.
Down but not out yet, Nigel. Well, we'll see where it goes from here. More importantly, in the second half, for the Nifty itself, the range of 24,250 to 24,550 is what the option writers were positioning themselves for. Now we're a little above the lower end of that range, 24,300 thereabouts. Let's see where we go in the second half, as we also have the July series expiry that plays out today. But like Nigel pointed out, it was the banks which were problem pocket for the market. Let's see whether HDFC Bank and Kotak Mahindra Bank actually lift their weight and, pull their weight on the Nifty Bank from current levels as well or not. But speaking about banks itself, we have Karnataka Bank on our radar. Gaining on the back of its strong set of second quarter earnings, we are joined by Sri Krishna H., the MD and CEO of Karnataka Bank, to discuss the past quarter's performance, but more importantly, look at the future and give us a peek into what that holds as well. Thanks a lot for joining in, sir. Deposits, that's been a bit of a scramble for the entire industry. So what is the kind of deposit growth that you're targeting for this year? And on the back of that, maybe if you could give us a sense of at what rate will your loans grow this year too?
Good morning and thank you for the opportunity. As you had mentioned, yes, we have had a decent quarter. On the deposit side, we've been growing at about 13 to 14% on a year-on-year annualized basis, and we'll continue to grow. The last year was a real turnaround for the bank, the financial year, and we have demonstrated the similar trend in the first quarter as well. As far as advances are concerned, it's a stated objective of the bank that we will reach 100,000 crore by exit March 26. So we are well on track, where we grow by about close to 19%. And we are growing on retail assets, which is a good sign, as well as very high-yielding assets on the mid-sized corporate and SMEs also. So overall, I think, we are on the right trajectory.
Okay, that's good to hear, sir. And thanks a lot for joining in. So we've got the loan growth number out of the way of around 19% and deposit growth of around 13% or thereabouts. What about NIMs? Sounding quite confident on the deposit growth. Will it have an impact on the NIMs, or do you think the high-yielding portfolio will be able to take care of it? For the last quarter, you have reported around 3.5%. What's the range we should work with?
Our guidance has been 3.5 to 3.7, and we stick to that, still. There are two reasons for this. One is that, our very strong branch franchise, which is about 940 branches as we speak to you today, and they are kicking in on retail term deposits as well as CASA. The second is that we have plans to develop a lot of features and new product rollouts in the liability side. We started with the senior citizens, savings account, followed now with self-employed professionals, entrepreneurs, in millennials, education and staff, students, etc. The other thing is that we have focused a lot on current account accretion through 2-3 products that we have launched, including a corporate payroll process account. Yeah.
Okay, that's good news. But now let's focus on the asset quality. We've got the growth numbers as well as the NIMs of around 3.5 to around 3.7%. Tell us more about asset quality. The slippage ratio is, I think, around that 2.5% or thereabouts, 2.2% of the last reported quarter if I annualize it. So what is the slippage ratio that we should work with, and the asset quality numbers as well?
About 0.8% has been our quarter slippage ratio now, and I think we stick to that. There is a historical book, I should admit, and which is pre-COVID, and the kind of pressure that we have. But the good news here is that the total of our GNPA plus restructured asset book, which as a bank there was a very conservative stand that was taken, has come down to less than about 5% of the overall book, about 5.3% to be very precise. So this is good news because directionally we are moving down quarter on quarter. Recoveries are happening in full swing, both the technical write-off book, which is directly into the P&L, as well as reduction in the overall NNPA. So directionally we are coming down quarter on quarter, and also with the corresponding quarter of the last year. So NNPA, while it is a little high still overall compared to multiple other peer banks, because most are near the 1%, we would target that net NPA would reach closer to about 1.2% by the end of this financial year.
All right, so 1.2% by the end of this financial year, at a time when everyone else is around 1%. You're looking to improve your books, the asset quality from current levels. Last year was a start into that journey. You are looking at almost 100,000 crores in terms of a loan book over the next couple of years as well. So let's talk about a couple of other things too then. In the loan growth that you're talking about, 19% over the next couple of years, where is it that you're seeing the most amount of traction when it comes to demand for loans, and where is it where the sell is a little too hard? We're just trying to understand what are the higher yielding assets for you, lower yielding assets for you, better quality. How do you manage that mix over the next couple of years?
Focus is on RAM, which is basically retail, agri, and mid-market, and this is going to continue. And over 50% of our accretion is all happening in this space. Our loan book is divided about a third or a little more than a third with large corporates, where we have said that we will get out of the bulk opportunistic kind of loans into direct to corporate lending. So we're strengthening our corporate business, mid-sized corporate business, with coverage teams and relationship teams across the country, at least for the main locations. Our industrial finance branch, corporate finance branch, and overseas branches are kicking in very well in the major locations. Last but not the least, we believe that the growth will be more granular to the tune of about 50+%, and towards a larger, let's say, ticket sizes for the mid-sized corporates and so on. The yield is obviously good from a retail perspective, although there are several challenges. We are setting up a collection system. We are also completely revamping our credit processes in terms of turnaround times, and we have plans to set up some very specific retail asset centers in major locations as we go forward. As far as the larger corporate is concerned, I think there is a lot of balance sheet lending. The good news about the bank is that about 90% of our overall loan book is still collateral based. Unsecured is a very, very limited portion, and which is only relevant to large corporates or PSU or some opportunistic corporate asset that we have taken. For the first time in the history of the bank, we would be getting into the unsecured space, for which we are strengthening both the processes, technology, and the collection mechanisms. And we will get there. There are a slew of products that we are launching, particularly on the digital space, where digital origination of retail loans, particularly related to UPI. So we will be launching a credit line on UPI very, very soon,
right,
and followed by a few other products on the retail space, which will be our charter into the unsecured territory for the first time.
All right, that will be very interesting. If you go into unsecured territory, maybe your yields will increase, but you are strengthening your collection processes, etc. as well. Just before we let you go, just wanted your word on two things. One, with all these things happening, one presumes that your cost to income ratio would increase. So what is your target cost to income ratio here as you are expanding? And secondly, with all of this, is inorganic a part of your mix? I mean, are you looking at some opportunities to maybe strengthen your capabilities, get books, or maybe get merged into someone else with the kind of capabilities that you have right now?
So you asked me two questions. One is
Yes.
in terms of the strengthening part related to our book and the overall processes, etc. Yes, there's a lot of effort. As you know, we have raised adequate capital, so that has created a lot of headroom as far as the overall infrastructural setup is required, and also setting up large back offices and national back offices in Mangalore. The second part, what you asked about, is the inorganic side. It is an opportunity that no bank would like to miss, and so we are. So we would be looking at any such very interesting opportunity. Book growth is not our objective. I think if there is distribution and everything related to the overall infrastructural, strength that we acquire, definitely, we would be looking at it. And to answer the last question, that are we looking at merger? I think we are looking at acquiring rather than being merged. So we are looking at some kind of acquisition, if at all that it comes. But I would not like to want any speculation here. So just to reiterate that this is something which is a normal process where we would be on the lookout for any such interesting opportunities.
Okay, and what about the size of the opportunity that you're looking at in this inorganic growth? For years, I'll tell you why I've asked you this, sir, because for years, there's been that murmur that maybe Karnataka Bank will get acquired. Now you're saying, no, that's not the case. We are on the lookout. So some size, some timeline, sometime during this fiscal year, we should hear about it?
I think that, this is a murmur and which will continue to be a murmur. But on the other side, we have strengthened our balance sheet. We have strengthened our capital. We have strengthened our management team and all the infrastructure related to technology and architecture. So there is no way that, it is something which can remain a murmur like that anymore, one. Secondly, I do not want to really say any timing here because this is very opportunistic in terms of the market. So as and when we do see some strengths that we can acquire through this process, we would certainly be open about it. And as I said earlier, I reiterate that we are growing our asset book by ourselves at about 19%, which is much ahead of the market. So we believe that a balance sheet size, our overall business turnover,
Right,
which we crossed 1,75,000 crores, which was about 1,45,000 crores about a year and a half ago. So this is very clearly an indicator that the growth is there as far as the bank is concerned in a very organic fashion. We would continue to push that forever.
All right, we take that point. Thank you so much for joining in and giving us the clarity on what you look at for the bank for as a way forward. That's about, Karnataka Bank. The stock holding higher on a day where the Nifty bank is actually down by almost 700 points. Good numbers, good guidance coming in from the management as well. At the bottom of your screen, we have Jyoti Labs numbers coming in. Net profit growth of just about 5%. Remember, they have been doing extremely well over the last few quarters, so maybe a bit of base effect catching up as well. Revenue growth of 8%, not particularly bad, again, on a high base. So margins would be extremely crucial to watch out for, given the net profit is lower than what the revenue growth is, whether the company has gone ahead and seen margin expansion or not. The stock has already been a big mover. Let's see where it goes from here. Time to get you some special ideas for profit coming in from our colleagues at Money Control Pro, and today we have Nitin Sharma joining in.
Today's stock idea is Cash Logistics and Solution Business, CMS Infosystem. CMS has delivered a good performance in the FY24 with revenue growing by 18% year on year. EBITDA margin stood at 26.5% and EPS growth was 15%. Flagship cash logistics business seen as revenue growth slower from the last year, but it expected to grow within the 10 to 13% range over the medium term. Its EBIT margin is also expected to be around 26 to 28%. Managed services registered a strong growth in FY24 of 30% with 20% EBIT margins. New order win this year stood at 1,850 crores. It now accounts for almost 40% of the group revenue. Managed services business is expected to grow by 20 to 25%, driven by the remote monitoring, banking automation, and other cash management solutions. CMS has multiple medium-term growth drivers, including ATM refresh and expansion cycle, and scaling up of the managed services. Management sees a revenue growth to reach 2,500 to 2,700 crores by 2025, which is well within the reach. At the current market price, stock is trading at a FY26 P of 19 times, which is attractive and has an upside from the current levels. Investors are recommended to add the stock.
All right, with that, we'll slip into a short break. Just as we do that, keep an eye out on Jyoti Labs. The margins have come in. It's an improvement of about 80 basis points. The revenue decline is largely, or the slowdown in revenue growth is largely because of their household insecticides business. All the other businesses have reported near double-digit growth, and that explains why the stock has moved to the high point of trade. Take a short break. On the other side, we have the management of Tips Industries. Kumar Taurani, the CMD, joins in.
Welcome back. You're tuned into Chartbusters here on CNBC-TV18, and it appears we are a bit of a good luck charm for the markets. As we speak, the markets have pulled back currently at the high point of the day. Now the Nifty is down a little less than 100 points. Let's hope this continues. Next management on the show, though, Tips Industries. Good set of numbers in the first quarter. Revenues rising by close to 40% on a year-on-year basis, while margins expanded as well, close to 700 basis points after a number of super hit music album releases in the first quarter. Mr. Kumar Taurani, the chairman and managing director, joins us on the show. Hi, Mr. Taurani. Good morning, and thanks a lot for joining in. Well, the new songs released have declined to around 97 odd. Could you give us the target for the year? What is the number you're looking at for the end of this year?
I think this year we are targeting somewhere between 300, 350 songs to be released.
Right. 300, 350 songs, Mr. Taurani, would be a lot lower than what you did over the last couple of years on an average. And I remember you had said that, you're focusing on quality more than quantity. So we just want to understand what exactly do you mean by quality more than quantity, because are these newer songs giving you higher yields per release than the earlier songs? What is your metric? How do you define quality versus quantity?
Yes, that's the idea. We should make more money on each song than focus on quality rather than quantity. So we are exactly doing that.
Okay, so how much will you make now in comparison to what you were making earlier? You're telling us that you're going for yield, right? So what is the difference?
Actually, we don't have a mechanism. We have recently put in a system where we can analyze song-wise also, which in the next 3-4 quarters, we will be having that data also. But at present, we just, in totality, we count. And as usual, I always maintain that we have to grow 30% top line, 30% bottom line. Has to be there. And this year also we target that we will achieve that.
Typically, if you could look at your content library and tell us how do you look at revenue per song? You said that you can't do it on a quality versus quantity, legacy songs, etc. All those metrics you are developing right now. But on a blended basis, on an average, with the content library that you have right now, revenue per song per quarter would be how much? And what is that metric likely to be going forward?
No, we don't have that metric because we have around 30,000 plus songs. But let me assure you, our 90s repertoire from we started in 1988 till 2020, I count as a repertoire catalog music. Its entire catalog is doing so well. That's why it's helping us to achieve all those numbers. Last year also, we achieved that number because of that. So our repertoire, old repertoire is doing well. Plus, since last year, we have started acquiring film music and investment in content. So last year, but we couldn't achieve our target of investment. This year, we are targeting to invest around 28 to 30% in acquiring new content. So let's see if we can acquire that kind of a content. So, but we are, I think, from this year onwards, we are increasing our acquiring of content, and in 1-2 years' time, we will achieve acquiring more and more content.
All right, Mr. Taurani, if you could give us a basic numbers. You're very passionate about your business, and the shareholders will be very passionate about the stock price and the guidance. So for this year, revenue should grow by how much? I think earlier you were talking about a 30% growth odd. And what should be the broad margin band? Because you had told us that top line as well as bottom line will grow parallelly.
Yes, 30% we will achieve top line, and also PAT also, we are looking at 30%. That is our target, and I am quite hopeful. And what I see, the way business is going and the way first quarter we have performed, I think we will achieve that.
All right, that is interesting. You so far have spoken, Mr. Taurani, of acquiring content, investing in content, and improving the quality of the content that you have. Let's look at the avenues of monetization now. you had signed a deal with Time Warner. So we wanted to understand whether that has begun to yield revenues yet or not. If yes, over the next couple of years, what could be the potential here? Has monetization happened for Meta? I mean, how much of your revenue currently of the portfolio comes in from these new channels like Spotify, YouTube, and Meta? When does that start flowing into your business?
Yeah, revenues coming from all the avenues now. And we had a deal with Warner Music. Time Warner is a film company. We have a deal with Warner Music. And we have a deal with them 3.5 years back, which was got over in March. And then we renewed the deal for another 4 years. And we have given them a few more services to handle, to do distribution on those platforms as well. And touchwood, we are really doing well. Our deal is MG business, minimum guarantee they will pay for 4 years. But we are keeping whatever amount we are receiving from them, we keeping in our books as advance. And we are, whatever reporting they give us, every quarter we get reports from them, what is the actual business has been done. We take that into our books. This business has done in this quarter. So, and touchwood, we are doing well. So it's not a problem. I feel they will ultimately, they will achieve their, whatever MGs they've given us, they will also make commission, whatever we committed and we have done the deal. Plus, I feel we will get overflow also on the deal.
All right. You feel that you will get overflow on the deal. Do you want to tell us what the MG is?
We can't reveal that, please.
A couple of $1 million. I mean, I just wanted to understand a broad range. If you could just, say $10 to $15 million, $20 to $30 million. What is the MG here?
It's the same thing. No, but it's just a very big deal. Good deal. Big deal.
Okay. We'd have liked more numbers, but that for another conversation, another time. Thank you for joining in. Wish you good luck for the remainder of this year as well. That's the management of Tips Industries. Will target over 300, 350 songs to be added this year to their library. But more importantly, they're looking at better revenue per song that they produce going forward and more avenues for generating that revenue as well. The stock from the lows has seen a bit of an increase. We take a short break, come back, focus on the markets and stock-specific action. Stay with us. Now less than 85 points on the Nifty. That means a stellar recovery from the lows. It's not only led by some of the heavyweight banks like HDFC Bank, which is off the lows of the day. We have Kotak Mahindra Bank at the high point as well. Just keep an eye out on L&T. That too was weak going into numbers. The numbers were largely in line, and as a result of which there is a bounce that we're seeing on that stock. L&T up around 2.5% at the high point of trade. So we'll wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next, and who knows, we see more recovery thereafter.